It's funny. I was just thinking back to when I first got into trading options.
Oh, yeah?
Yeah, it was all about trying to pick that one stock that was going to skyrocket and just loading up on calls.
Right, or puts if you thought it was heading down.
It's a full approach.
Exactly.
Yeah.
That feeling of trying to catch that big wave. I'm guessing a lot of people starting out, you feel that same pull.
It's very intuitive, isn't it? It
Yeah.
kind of mirrors how you think about stocks pick a winner.
Absolutely. But after, years of actually trading these things day in, day out at advancedautotrades.com, well, what we've really learned is that consistently trying to hit those home runs with single options, it can be a really tough game.
And often risky. Very risky.
Yeah, and that's what we really wanted to unpack today, why we always trade option spreads. It's like the absolute cornerstone of our strategy.
It's fundamental to the framework we use, the one we aim for consistent results with.
It is. We've just seen too many traders get burned, frankly, even when they weren't necessarily wrong about the market direction.
Exactly. Their outlook might be spot on. With single options,
Yeah,
they have other dimensions.
right. So today, we want to share some of those key lessons, why we genuinely believe using option spreads gives you a much more strategic path.
Safer, too, because the risk is defined.
Totally. Defined risk, and honestly, a more forgiving way to navigate options compared to just buying those single calls and puts.
So where should we start? The pitfalls of those single options.
Let's do it. Because that initial appeal is strong, but the challenges aren't always obvious right away.
Okay.
Well, the first big kind of wake-up call for me was realizing that just being right about direction, like with stocks, often isn't enough. Not even close sometimes.
Right. Options are more complex.
It's like they operate in 3 dimensions. You've got direction, sure, but then there's how much the stock moves.
Yeah.
The magnitude.
Okay. Direction and magnitude.
And then crucially, the timing, the speed. How fast does it get there?
That's a huge difference from stocks, isn't it? With a stock, you can often just wait it out if you believe in the company. Time can be your friend.
Not with options. They have that expiration date. Time is absolutely not always on your side.
Which leads to problems.
Yeah, what I call the magnitude problem. Think about this. Stock's at $100. I'm bullish. Buy a $100 call for, let's say, $5. $500 per contract.
Okay. Standard enough setup.
Now, for me to even break even by expiration, that stock doesn't just need to go up. It needs to go above $105.
Right. This is strike price plus the premium paid.
That's a 5% move. More than 5%. Just to get back to zero. Before commissions even.
And that's often where people get tripped up, isn't it? They pick the right direction, but
But the move isn't big enough. The stock maybe goes to $103, $104, $104. You were right. It went up.
the option expires worthless.
Exactly. You lose that $5 premium. I remember that feeling so well, thinking, but I called it. The stock moved up. My account didn't care.
It really shows the leverage. It cuts both ways. Need for precision, direction, magnitude, and timing.
And then layer on top of that time decay, theta. Ugh.
The silent killer for option buyers.
Totally. This was another real eye-opener. Even if the stock does start moving your way, but it does it too slowly, that option is just bleeding value every single day.
Because it's getting closer to expiring worthless.
Yeah, think of it like, I don't know, an ice cube melting. Even if it's not super hot out, it's still disappearing just because time is passing.
That's a good analogy. The option's time value just evaporates.
Exactly. I can vividly remember buying calls, seeing the stock tick up slowly, and my options value, it's flat. Or even still going down.
Oh, that's frustrating.
Incredibly frustrating. You're right on direction, but time is just eating your lunch.
Okay, so single options.
Mm-hmm.
You need the direction, the magnitude, the speed, and you're fighting time decay. That's a lot to get right.
It really is. So how do spreads offer a different approach? A potentially better one?
This is where it gets interesting.
Yeah, this is where we saw a real shift. Let's use that same bullish example. Stock at $100. Instead of just buying the $100 call for $5.
You do something else.
We look at maybe a bull call spread. So yes, you still buy that $100 call, but you also sell a call at a higher strike, maybe the $105 call.
Okay, so buy one, sell one further out of the money. What does selling that higher call do immediately?
Well, the big thing is you collect premium for selling that $105 call. And that cash you collect, it directly lowers the cost of the whole position.
So it offsets the cost of the $100 call you bought.
Precisely. So instead of paying $5, maybe the whole spread, buying the $100, selling the $105, only costs you, say, $2.
That's a big difference. Less capital tied up.
Huge difference. And think about what that does to your break-even point.
Right. The single call needed $105 to break even.
But because we only paid $2 for the spread, our break-even drops. In this example, it's down to $102.
So the stock doesn't need to make such a huge move for you to potentially profit.
Exactly. We've made profit more achievable with the same basic bullish view. It just gives you more breathing room.
More capital efficient, less pressure for that massive jump right away.
Totally. And it's not just about calls or being bullish. You mentioned time decay being the enemy for option buyers.
Yeah, the melting ice cube.
Well, with certain spreads, time decay can actually be your friend. It can work for you, especially with credit spreads.
Okay, explain that. How does time decay become helpful?
With a credit spread, you're typically selling an option that's more expensive, often closer to the money or closer to expiration, and buying a cheaper one further out for protection.
Right, you collect a net credit up front.
Exactly. And those options you sell, the more expensive ones, they tend to lose their time value faster than the cheaper ones you bought for protection.
So the part you sold decays faster than the part you bought.
You got it. So as time passes, assuming the stock behaves, the value of the option you sold drops faster, allowing you to potentially buy it back cheaper later for a profit. Time is now working in your favor.
That's a complete flip. Instead of fighting the clock, you're using it.
Yeah.
Within a defined risk structure, too.
That's the key. Defined risk. Always. So putting it all together using spreads lets us manage that whole three-dimensional game direction, magnitude, speed much more effectively.
It feels more like strategic positioning than just making a bet.
It really does. Smarter trading, not just harder guessing.
Which brings us to something you guys feel really strongly about. Naked options. You never sell them.
Never. Absolutely non-negotiable for us at Advanced AutoTrades. And we strongly advise against it for everyone, especially beginners. The risk is just astronomical.
Can you spell out what that unlimited risk really means? Let's start with naked calls.
Sure. Selling a naked call means you're betting the stock won't go above a certain price. But what if it does? What if it goes way up? A meme stock situation, a buyout, anything.
There's no theoretical ceiling on how high a stock price can go.
Exactly. So there's no theoretical limit to how much money you could lose. You're obligated to deliver shares you don't own at a potentially much higher price. It's unlimited loss potential. Terrifying.
Okay, truly unlimited. What about naked puts? Slightly different risk profile.
Different, but still potentially catastrophic. Selling a naked put, you're betting the stock won't go below a certain price. If it does, and it plummets, think market crash, bad earnings, you're obligated to buy the stock at the higher strike price.
So your loss potential is substantial down to the stock going to zero, theoretically.
Right. While not technically unlimited like a call, the stock can go to zero, meaning you could lose almost the entire value represented by the contract. It can wipe you out. A single bad trade.
It sounds less like trading and more like, well, gambling on not having a black swan event happen.
That's exactly how we see it. It's gambling, not strategy. Way too little control over the downside. That's why, if we want to collect premium, take advantage of time decay.
You use defined risk strategies instead.
Always. Things like credit spreads, which we talked about, iron condors, defined risk diagonals.
And the key difference is that defined risk part.
It's everything. From the moment you put the trade on, you know the absolute maximum you can lose, period. Because you always have that protection leg, that other option you bought.
It hedges the one you sold.
Correct. It puts a cap on losses. That lets us, and hopefully our members, actually sleep at night. Even when the market gets choppy, we know the boundaries.
That predictability, that control, it's just not there with naked options.
Not at all. So going back to that three-dimensional game idea, spreads are really the tools that let you manage those dimensions.
How so? Different spreads for different views.
Exactly. If we have a strong directional view, we might use a spread with a higher delta, meaning it moves more closely with the stock price.
So you can still be directional, but with that risk cap in place.
Precisely. But if we think a stock is going sideways, just chopping around in a range,
then maybe a credit spread or an iron condor.
You got it. Strategies designed to profit from time decay and low volatility. And there are even spread strategies for playing changes in volatility itself.
It really sounds like a much more versatile toolkit compared to just long calls or puts.
It absolutely is. We've spent years at Advanced AutoTrades building and refining our systems around this philosophy. Always use spreads, never use naked options. It's core to how we deliver rules-based, risk-managed trades.
And you mentioned results earlier.
Yeah, and look, past performance never guarantees future results. We always have to say that. But that philosophy was absolutely key to achieving those 80% returns we reported last year. And we did it without ever touching a naked option. Not once.
That's a powerful point. Good returns don't require taking on unlimited risk.
They really don't. And let's be real, nobody gets all three things: direction, magnitude, speed perfectly right every time. It's impossible.
The market's too unpredictable.
Exactly. But spreads, they give you that crucial room for error. Your risk is defined up front. The cost is usually lower than buying options outright. And you can often still make money even if the market only kind of does what you thought it would.
More resilient, more adaptable to uncertainty.
That's a great way to put it. And that's why every week we share these pre-built rules-based spreads with our members. Defined risk, based on our models, aiming for consistency, trying to take some of the guesswork out.
Okay, so for listeners who are maybe still mostly trading single options, what's the main takeaway?
The main thing is, please just stop and rethink that approach. Seriously. We've been doing this a long time, and we've seen the boom and bust cycle that comes from just swinging for the fences with single calls and puts.
You might get lucky sometimes.
You might. But for long-term success, for consistency, we truly believe you need a smarter edge.
And that smarter edge, for you guys, comes from using spreads strategically.
It really does. Our experience just shows they improve our odds over the long haul. They're strategic, they're calculated, and critically, they offer control over risk that single options just don't.
So it's less about predicting perfectly.
And more about understanding probabilities and structuring trades properly, using the right framework.
Shifting focus from home runs to building a resilient portfolio with smart structures.
That's it, exactly.
If you enjoy this episode and want to stay ahead with fresh insights every other day, don't forget to hit that subscribe button or follow our podcast. We've got more exciting content coming your way, and we can't wait to have you back. See you soon.